Hey, good people. Before we start this podcast, I wanted to let you know a little something. If you haven't heard about Anchor, it's the easiest way to make a podcast. Let me explain. First of all, it's free. And not only that, there are all these creation tools that allow you to record and edit your podcast right from your phone or your computer, just like I did. Anchor will also distribute your podcast for you so it can be heard on Spotify, Apple Podcasts, and many other platforms. You can even make money from your podcast with minimum listenership. It is everything you need to make a podcast in one place. So what do you need to do now? Download the free Anchor app or go to anchor.fm to get started. Hello, good people, and welcome back to another episode of Real Talk and Real Estate with your girl, Kim McBride, also known as Get Keys with Kim. I am joined today by Mr. Brian Sachs of Homebridge Financial Services, who will be telling us a little bit more about investor lending. So oftentimes when people think about investing into real estate properties, they feel like they just solely have to come out of pocket with their own money, or they may need to go to a hard money lender. So we're going to have a little bit of conversation about how you can go about doing that, but other options that may be out there that you may not have been aware of. So let me tell you a little bit about Brian. So it was in 1985 that Brian Sachs decided to transition from working as a real estate agent to a loan officer. He fell in love with the business instantly and hasn't looked back since. Currently, he has a marketing assistant and a loan officer assistant on his team, and together they cover Washington, D.C., Maryland, New Jersey, Pennsylvania, and Florida. And although they offer all types of loans, including conventional, they're currently the number one lender in the country for 203K renovation loans. Three things that set them apart are their knowledge, communication, and honesty. And having been in the business for 35 years, he has an immense amount of knowledge and experience, so he's able to guide his clients through the transaction and ensure that there are no surprises. While Brian's skills and integrity have helped him reach great heights in his career, it's his love for the industry that has made it his true calling. He's been quoted as saying, "I enjoy helping people, especially those who have suffered setbacks in their lives. The joy I see when I've helped someone really makes me feel good." So everyone help me welcome Brian Sachs with Homebridge Financial Services. Hi, Brian.
How are you, Kim? And I'm honored to be here. Thank you for having me as a guest.
No, thank you so much. I remember about a year and a half, maybe about 2 years ago, a few years back, we were able to connect and network. And I love the information that you shared with me at that time. And I think it is extremely valuable for anyone who's in the real estate business, whether it's a realtor or real estate investors or someone that wants to get into real estate, to know the information that you shared with me. So even though this won't be the only time that you're on the podcast, I was excited to start with talking about investing and lending and how they come together. So Thank you so much.
Thank you. So, obviously, we're in a period of phenomenal interest rates. So whether someone's looking to buy or invest, there really couldn't be a better time.
Okay. I like to hear that. So let's talk about that. And we can start with actually the purchase of an investment property or even the programs that you offer, wherever you want to begin. How does one get into obtaining lending for a property that may not be their primary residence, is solely an investment property?
Sure. Well, it begins the same way you would if you were buying a home to live in as a primary. The first step really is to meet with a lender, get pre-approved, know what financing options are out there. With an investment property, obviously you're going to need to understand what neighborhoods rent for. And I know that's something you have an expertise in, Kim. And you're going to need to know what your payment's going to be. So you want to be in an area, obviously, where if you're going to be buying rental property, the properties in the area rent for the same or more than your mortgage payment will be, unless you know something, unless you know for some reason in the next year or two, something big's going to happen there and you can afford to, sort of subsidize the property. You really want to make sure that you're in a situation that gives you a break even, or even better, a positive cash flow. And because rates are so low right now, there are many opportunities to do just that.
Okay. So, and it sounds like from what you're saying that you're also speaking of maybe a buy and hold. So an investor looking to make a property into a rental income, an additional stream of income for them. Is
Correct.
the process still the same for those who want to rent? I'm sorry, who want to buy and flip? Do they
Well,
go through the same steps?
you're still going to want to, yes, either way, regardless of whether you're buying and holding or buying and selling, and renovating, you still want to make sure that you're in a position to be pre-approved first, because the properties out there that are the real opportunities, they go quickly. And you really want to make sure that you've done all the front end work, which is get a mortgage in place so that you can react appropriately.
Gotcha. So with the first step being the pre-approval process, how does that work for investing? Is it the same as if you were buying? Are you giving pay stubs and W-2s, and are you doing all of that? Or
We're doing exactly that, right? We are looking at your W-2, your income, and if you're self-employed, there are options. We'll look at your tax returns for the last 2 years. If you are salaried, we're going to be looking at your W-2s for the last 2 years, pay stubs, bank statements, and of course, a credit report. And, while we're talking about credit reports, Kim, you don't have to have perfect credit to obtain a mortgage.
mm-hmm. And so for those who don't know what perfect credit is, or what the minimum credit score is to purchase, what would you say that would be?
Well, perfect, to answer that part of it, perfect is 850, and I've never seen anyone that's perfect. I've seen some people that are close. If you're getting a regular primary residence, a mortgage for a primary residence, you're really looking at credit scores, could be as low as 580 to the 600 range. When you're buying an investment property, typically we want to see you be a little bit higher, and certain programs have certain restrictions. So, you want to be in the upper sixes, low sevens generally. And again, there is also private money out there, and maybe they care even less about credit. But if you're going for a standard mortgage for an investment property, it's probably you want to have your scores in the upper sixes to mid sevens, depending on the product.
Okay. And so just kind of backing up to speak to something that you mentioned earlier, you said that you would collect certain information, financial information, from what will be either a future investor or a current investor. You also stated that there are options for those that are self-employed. What about the investors that may already be seasoned and or maybe new to the business but have a business entity? How would you gather those documents?
Yeah, so that's an interesting issue. Fannie Mae and Freddie Mac, which is a conventional loan. So actually, let me back up for a second. If you're a veteran or you want to obtain an FHA loan, those two products are only for primary residences. They do not do any investor programs at all.
And this is Fannie Mae and Freddie Mac.
VA and FHA do not offer investor products.
Okay.
Fannie Mae and Freddie Mac do, and they will not lend to an entity. They will only lend to a person. So you either have to use a bank or institution, if you want to get the loan strictly in the entity's name, or there are some products we have that are non-Fannie Mae, Freddie Mac products that do allow entities to borrow.
Okay. So can we get into that piece? Because you've mentioned maybe a few products and services that you offer. Can you share some of those with me and tell me what the difference might be between those?
Sure. So, one of the products that I think so few investors know about, and it's an applicable product, Kim, whether you're buying to hold or buying to sell, is the Fannie Mae Homestyle Loan. And a Fannie Mae Homestyle Loan allows you to purchase a property, roll in all of the renovations into one loan, and put a minimum of just 15% down if you're not going to be living there and using it as an investment property. So it's a phenomenal product that really very few know about, and even fewer lenders know about or do a good job with. So that's called the Fannie Mae Homestyle. Fannie Mae itself will allow you just to do an investor loan with 15% down. But the Homestyle allows you to actually roll in those renovation costs. Very, very attractive program, and probably one of the most underutilized out there for investors. The other product we have, and oftentimes we have people, and I'm sure you run into them as well, Kim, that are self-employed. Perhaps they're even a contractor, and they are able, because of their abilities, to buy some properties, do some renovation themselves, and so forth. We have a product that we don't ask any income questions, and the way that product works is you have to put down 15%. It's only available for single family homes, townhomes, condominiums, and 4-unit dwellings. And that's an important point. If I could pause for a second, Kim. Anything over 4 units is considered a commercial property.
Okay.
Properties 4 units and below are considered residential. And this product allows you to put 15% down. And as long as 3 things are in place. First thing, that you have at least a 720 credit score.
Okay.
Second, that you're putting 15% down. Third, that at least one of the applicants has been able to demonstrate a 12-month history of owning or managing a rental property, and there's no income. So they're going just on cash flow. If your rent on that property, what the appraiser tells us that property will rent for, is the same or greater than your mortgage payment on that property, no income questions asked. Okay. So that's a phenomenal opportunity for a segment of investors that no longer necessarily have to go to a hard money lender. And in this product, they actually will lend to an entity.
Okay. And you did mention a few things I wanted to ask you a question about. So with that particular program with the 4 units or less, even though it's an investment property, can the investor live in one of the units?
Oh, such an excellent question. I'm so glad you asked that. So one of the biggest opportunities out there is to buy a duplex, triplex, or 4-unit. If you're going to be living in one of the units, and the property, of course, has to be legally zoned, if you're going to be living in one of the units, we can actually count the rental income from the other units as income for you. And now, if you're a veteran or you want to use the FHA program, a VA, you could get in with no money down, literally 0 down, as long as you have full entitlement and qualify. And with FHA, you could get in with just 3.5% down. So let's talk about that for a second, Kim, if I may.
Sure.
So, I like to sort of phrase it this way. How would you like to buy a home and have others make your mortgage payment for you? Because that's exactly what happens in many of the cases with clients that I assist. And it sounds too good to be true on the surface, doesn't it?
But it is. I want to say for the record, Brian, I would love that. I'm just saying.
There you go. So let's play it out, right? Let's say you have a 3-unit property and it's going for $250,000. Okay.
Okay.
And one unit rents for 750 and the other unit rents for 750 and you're going to live in the third unit. Well, your mortgage payment's going to be about $1,500 a month. So the rent you're collecting from those 2 units actually makes your mortgage payment for you. That's a beautiful situation. And if you're going to live in one of the units, now you actually are eligible for a VA or FHA renovation loan. So if the property needs a little bit of, touching up or renovations, we can lend you the money to do that too, as long as you're going to live in one of the units.
Okay. And there's no restriction in time. It's not something that says you have to live in the unit for 5 years or 10 years, or is it just at the time of purchase you're living in this home?
Well,
just to be clear.
There's no time frame for how long you have to live there, but you do have to occupy the property within 60 days of settlement.
Okay. And just for kicks, let's say someone does not do that. What then happens? So the deal has closed, you have the keys, you don't move in within 60 days. What could happen?
Well, what could happen is they could call your loan due and payable and prosecute you if they feel that you lied. Okay. And that's a federal offense. So, I don't know that
people bars might be in that future. Okay. Yeah. I hear you.
Yep. Stripe suits. Yep.
Stripe suits. That's right. Okay. So with the no income product, you mentioned that it's only for single family homes, townhouses, condos, and 4 units. Are there homes that are restricted? Because that seems to cover a good portion of what's normally on the market. Is there anything that's excluded? And I guess we can also speak to that for the home style. Are there any properties that are excluded from either one of those products?
There really isn't anything excluded, but generally our minimum loan amount is going to be $150,000.
Okay.
So there's no exclusion, but generally that's going to be kind of where our rates and our products cut off at a $150,000 loan amount.
And that's $150,000 including the purchase and the renovations, or?
Yeah, it could be. Could be either, as long as the actual loan itself is $150,000 or above, we're okay.
Got it. And then you also mentioned for the no income product that there needs to be a history, at least a 12-month history.
Correct.
Of maintaining, of managing or owning a rental property. So does that have to be current holdings? Like, do you currently have to have in the past 12 months? So let's just say back in 2012, I had a property from 2012 to 2017, but now I don't have any rental properties in my portfolio. Would I be eligible, or is it the 12 months immediately preceding when I'm looking to get that loan?
So the guideline is 12 within the last 12 months that you have owned or managed an investment property.
Gotcha. Okay.
But look, there's every rule has an exception, and so if we have a strong case, we can always ask for an exception.
Understood. And then one more thing as it relates to credit, if we can jump back to home style. Is there a minimum credit score for that? So for the no income product, the credit score has to at least be a 720. What about for home style, for the Fannie Mae home style product?
It's really going to be, they want you to be in the upper 6s to low 7s as a minimum score, but really it's a case by case. It's going to depend on your ratios. It's going to depend on your reserves. The more reserves you have, the better. So all of these loans are going through an automated underwriting process, except for the no income, of course. And, what they like to see is if you have a low score, but you have good ratios, good income, low debt, and excellent, reserves, cash in the bank, Well, sometimes they can offset credit.
Understood. And for those who may not be aware of the two terms that you use, can you break down what reserves are as well as the automated underwriting?
Sure. Reserves really means how much money do you have left over after the loan settles? Are you sort of tapped out, or do you have a significant savings account that could tide you over should a problem occur, or till you get the property rented out? In terms of ratios, what that means actually, I guess, broken down into normal terms, the way we qualify you as a lender is we allow a certain percentage of your income to be assessed for a mortgage payment and a certain portion of your income to be assessed for a mortgage payment plus your debts. If you're a brand new investor and you're going to have a mortgage payment of, let's say, $1,000 a month, we like to see that you have $6,000 left in the bank after you put your money down and pay closing costs. So I hope that addressed that question, Kim.
Okay, so that's reserves. And then the automatic or the automated underwriting?
Well, these are actually, we've gotten to the point of, I guess, such artificial intelligence where computers are making decisions. And so your file is analyzed based on by a computer program. So, if you go to some of these online lenders, you hear push a button, get a mortgage. That's how they do it. It's an automated underwriting system. And that automated underwriting system is already pre-populated with these ratios and different scenarios in terms of assets, income, credit, and so forth.
Got it. Okay. So that's just the computer kind of giving the green light, so to speak. The information is input into a system and then a result comes back. Yay, nay, maybe.
Correct.
More information, something. Okay. So what about in situations or scenarios in which there are multiple people looking to purchase a property? So let's say a family of four. Maybe it's a mother and a father and two children, and they want to buy an investment property. When we're looking at reserves, when we're looking at credit score, income, is that for everyone, or is there someone that is the primary go-to person as far as the loan is concerned? How does that all tie in together?
It's a great question, Kim. If everyone's going on the mortgage, we're going to put everyone's income into one pot, everybody's assets into one pot, everybody's debts into one pot. In terms of credit, though, we are going by the middle score. Now, there are three repositories most people are familiar: Equifax, TransUnion, and Experian. We are going by the lowest middle score of whatever person that is, any of those four people you mentioned. We're going to go by the lowest middle score of the four people.
Okay. Got it. Okay. And what about, you mentioned if of those four, they all want to be on the mortgage, yes, you would need to gather all of that information from everyone.
Correct.
Are there any circumstances where, let's take that same scenario, where mom and dad want to give one of the children, so one of the children wants to purchase a property, and mom and dad want to be able to use income, but not be on the mortgage? Is there any scenario where something like that would be possible, where you can take the income of others without them having the responsibility of the debt of the home? Okay.
I hate to give you such a short answer, but no.
I like short and sweet. That's good. No. So these products that you have shared, are these considered to be 203K loans or something else?
No, a 203K loan is an FHA program that allows you to purchase a property and rehabilitate it. Because it's FHA, if you recall, it's only going to be available for primary residents. So the only way you're going to be able to use a 203K and get a property that yields you rental income is if you're going to live in one of the units and rent out the others. If you're buying strictly to invest, then you're going to have to use the Fannie Mae home style loan.
Got it. Well, since you're the expert and we're already on the topic, can you talk about how that process would work? So let's just say someone thought that they could use a 203K loan for investing, but they can't. But now it may be something that they may want to consider for themselves personally. How does the 203K loan work? Is it the same process as what we've been discussing?
It really very much is. We're basically going to lend you the funds to purchase that property and do the renovations all in one single loan. And, the key really is if you're looking at properties that require extensive renovation, it's always a good idea to take a walk through it with a contractor you might consider using just to be safe.
Okay. So you can use, as far as the renovations are concerned, you can use any contractor,
Well, it can't be any contractor. It's going to have to be a licensed contractor. We don't care as long as they have a state of Maryland license and have sufficient insurance and bond. But here's the rub, I guess, Kim. Okay. With these renovation programs, we generally are not giving the contractor any money up front for supplies or anything else until some work's been done. So there are contractors out there who really don't have the wherewithal to do that. They're more handymen than they are, contractors able to renovate. And so you really need to make sure that you're working with a contractor that understands that, they will get paid in phases after inspections happen, but, they're not getting half up front and half in the end. It just generally doesn't work that way. We will work with the contractor to establish a mutually agreeable draw plan, but it's really something that you got to be very sensitive to and make sure you have the right contractor. Not every contractor is the same.
And is there ever a case where it's okay for the purchaser to, quote, front the money? So let's just say the contractor is not able to.
I could just tell you up front, no.
Okay.
And the reason I say it so quickly is because it's an extremely sensitive issue. And it's also an issue that puts you and us as the lender at risk if the contractor disappears. So sometimes we will make an exception and even provide some supplies. We'll say, go to Home Depot and we'll pay a couple thousand in supplies to get you started. But we don't really like to do that.
Got it. Okay. I understand. I've had that experience of a contractor running off. So I know how convoluted and complicated that scenario can get. So
it puts both of us at risk. And that's really why we try not to do that.
Absolutely. So when we're speaking about 203K loans or the Fannie Mae home style or even the no income product, what are the purchase limits? So the minimum is $150,000 loan.
Sure. Well, we can go, we can go well into the 5, 6, 750,000 range, depending on where the property is located, how many units it is. The prices vary from the loan amount sizes vary from jurisdiction to jurisdiction and state to state.
Okay. And as far as the renovations are concerned, how basic or how extravagant can they be? So are we talking about, getting a loan with the renovations included for very simplistic, just making sure that there are floors and cabinets? Or if I want to get granite, if I want to put in a pool and a fireplace, can I go as far as those different types of amenities in the home?
Sure, absolutely.
Okay. Is there anything I can't do as far as, and I meaning anyone who's listening and would be interested in investing in real estate, anything that cannot be purchased as it
Um,
relates to or included in renovation?
nothing really comes off the top of my head, but you just, the one thing that we are going to do to protect you and us is we're going to make sure that you are not over improving the property.
Okay.
And so if you're doing extensive renovations, whether you're doing it for an investment property or a primary residence for that matter, you're going to need to employ the services of a additional person. And that person is called a HUD certified 203K inspector. And there's a list of them. And certainly I can provide you with some recommendations or suggestions, I should say. And that's where the process starts. And that person becomes your quarterback and walks through the property with you to tell you this has to be done and this could be done so as not to affect the value. You don't want, we're not going to let you build a $600,000 property in a neighborhood of $400,000 properties.
Got it. Okay. Makes perfect sense. So even along those lines, what if someone is interested in things like solar panels or, having energy, making their house green, going energy efficient? Is that an option? Can someone purchase solar panels?
Absolutely. Yeah. And solar panels are purchased and sometimes solar panels are leased.
Okay.
So yes, anything you could do to make it energy efficient actually could help you with your interest rate and could, generate tax credit for you as well.
Understood. I like. So speaking of interest rates, what are we looking at as far as these products are concerned? What are the interest rates and terms? I know some will vary, but on average, or even if you can say, you might not be able to, but
yeah, they're really on a case-by-case basis. And I can tell you, Kim, the non-Fannie Mae products, like the product where we're just looking at your rental lease versus your mortgage payment, that no income products clearly going to be at a slightly higher interest rate. A Fannie Mae home style loan for an investor is going to be at a slightly higher interest rate. An FHA 203K for a multifamily is going to be at a slightly higher interest rate. But what will determine that interest rate is going to be a number of things. Number one, what product are we using? Number two, what is your credit score and profile? And number three, where is the property located? And, all those things are taken into consideration to give you a loan amount. So it's impossible for me to give you a, interest rate, for any of these products, but I can certainly talk in generalities if that's helpful. If you're buying a multifamily home that you're going to live in and you're going FHA or VA, because remember we said as long as you're living in one, you can go buy up to 4 units, FHA or VA, you're going to be looking at an interest rate that's probably in the mid threes. If you are looking at a home style loan for an investment property, you're probably going to be looking in the upper fours. And if you are looking for a no income loan where the rental income is all that's taken into consideration, you're probably looking in the 5s or 6s.
Got it. Okay. What about current interest rates? What if we were just doing a sole or straight purchase?
Well, same factors. Same factors are going to be taken into consideration. But what I can tell you right now is we're sort of at an aberration. I don't think anyone foresaw rates being this low right now. And right now, I mean, we're giving 30-year fixed rate loans in the 3.25%, 3.5% range. So rates are ridiculous. They're phenomenal. And they're phenomenal given that we have a phenomenal economy on top of it with, full employment and home prices going up. So, if there was a great time to buy, I think this is it.
Absolutely. I know when I purchased my home almost 6 years ago, rates were slightly higher than they are now, just a little bit, not by a lot. So that's amazing that even, 6 years later, we're looking at extremely good rates.
Yeah, it's a real opportunity, honestly, for someone who wants to get in, and also a great time to be investing because clearly, home values are going up, and great time to get in with low rates because I don't think they're going to be around forever.
Yeah, absolutely. Okay. So I know this will be a matter of personal preference, but and for each individual, but if you could, who would be the ideal candidates for these types of products, if there is one?
Anyone that wants to make money in real estate would be perfect for any of these programs.
Okay. I like that. That might be almost the whole world. I love it. Okay. And so what makes these products different from hard money lending? Because we mentioned that a little bit earlier, and there is a difference. So what makes them different?
Well, there's some pros and cons. Okay.
Okay.
So, being totally transparent about this. So let's talk about the pros of using hard money. And I actually have some relationships where we can offer hard money as well. We have a hard money program that allows you to put 20% down on the purchase and will allow you to finance 100% of the renovation.
Wow. Okay.
So let's talk about it. The good news with those programs is you can generally settle as soon as title work comes in. There's really very little. The investors have to like the property and they have to like you. And they have to, believe that you're able to do the job or get the job done, and B, that you are going to actually go forward with it. And so the good news with those programs are it's very, very quick. The other good news with those programs are they care much less about your income and your credit. They care a lot more about your character and your ability to move forward and your seasoning and experience. So if I'm standing at the courthouse wanting to buy a foreclosure property and it needs to settle in 30 days, hard money may be your best bet. Or if Kim's taking you out and you're finding a property and there's 39 other offers in there, well, if you can put in a cash offer, that's certainly going to be your strongest offer for the seller. So the good news with hard money is quick. You can settle very fast. And what might hang me up as a standard lender might not hang up the private money people. And that's why people go to private money. The bad news is you're going to pay a very high rate. Generally, You're going to pay 12 to 15%. You're going to pay anywhere in upfront fees called points. 3 to 5 is the standard. And certainly not a great recipe for buy and hold. Might be a decent recipe for buy and fix, depending on how quick you can fix it. But, they also generally only want you to keep that money for 6 months. And after 6 months, you may have to pay them more fees if you can't get out. Mm-hmm. So, I'm not saying anything against hard money. It's right for the right person in the right situation, but it's not the only option out there.
Understood. Which is a common misnomer. A lot of people don't know that you can go the traditional or standard route of lending for investment properties. Right. So,
exactly.
Yes.
That's exactly correct.
And I know in us speaking before that there is a process that you offer to refinance out of the hard money loans through one of your products.
Well,
can you talk a little bit about
absolutely. I mean, this rental, if you qualify for that program, that is where your lease is the same or more than your mortgage payment. So it means you have a credit score of 730 or above, a 720 or above. It means that you have a history of owning or managing rental properties in the past 12 months. If you have any of those situations, it's a great opportunity to refinance out of any of the hard money loans you may have taken just to get into a property.
Got it. I love it. Brian, this has been so informative.
Thank you.
And I will tell you that even just finding out myself, I'm in this business. I knew about the home style, but I've never actually had a client use the home style product before. A lot of my clients, when they're doing investment purchases, are either doing cash if they are able to do it, or they're going the hard money route. So I love to be able to share information that is not widely known and or not known at all. So I truly appreciate you taking time out of your day to be able to educate not only myself, because I learned a lot today, but also our listeners. So thank you so much.
It's truly a pleasure, and I'm honored to be here. I'm honored you asked me.
No, I appreciate that. And folks, thank you again for joining us for another episode of Real Talk and Real Estate with your girl, Kim. Don't forget to follow me at Get Keys with Kim. Brian, where can they follow you? How can they reach you?
Well, sure. You can reach me at my office, 443-471-8557. My email, bsacks@homebridge.com. That's homebridge.com. Or you can go to homebridge.com/Brian Sacks, SACKS. Or if you didn't catch any of that, just give Kim a call. Kim will connect.
My number, for those that don't know, is 410-961-2742. Thank you so much, Brian, and have a great rest of the day.
You too. Thanks again.
Bye.
Bye.